Hi Alberto. I want to inform you that we are accepting new client in our audit firm.
Hey. Okay. Have you investigated and evaluated the client's position in the business community, financial stability, and their relation with previous auditor?
Yes, I have already done that because it is very crucial to verify the integrity of the client, and the possibility of fraud, since it will be difficult to uncover fraudulent.
That's right. Have you contacted the previous auditor whether to accept the engagement or not?
Yes, I have. The client already gave me the permission to communicate with the previous auditor, and then, I contacted the auditor right away.
Okay. Good job. Bill, since we are both auditors, may I ask you something about continuing client? Sure. What is it? Can we discontinue a relationship with a client? Yes, we can. We can discontinue a relationship with the client which is lack of integrity and have ethical issues. Oh, we may also consider the association with particular client if there are issues in our opinion, fees and others. Am I right? Yes, you're right.
Okay class. Do you have any question?
Excuse me, miss. I have a question. I still didn't understand about engagement letter under the scope of audit work.
Alright. Engagement letter is a form of written material be prepared, agreed and signed by auditor and the client once the auditor accept the client.
Oh. So what should be included in the letter?
This letter should include the objective and the scope of audit of the financial statements, the responsibilities of auditor and management, identification of the applicable financial reporting framework, the reference of expected form and content of the reports to be issued by auditor.
Wow. That's a lot.
Lastly, a statement that may be differ from the expected form and content.
Okay, what else can be included?
The auditor can also include in the letter about the fees, assistance from the client's staff and others.
All right. The book has stated about repeat audit, which I don't really understand. Can you explain?
For repeated audit, the auditor can send a new engagement letter if there is any material changes, like a significant change in the nature or size of the client's business.
Oh. Now I understand.
Alright. Today we are going to learn about fraud and error under the scope of audit. What do you understand about fraud and error?
Error is a mistake done accidentally, while fraud is an unethical behavior and intentionally done.
Yes. That's right. Under the scope of audit, error is an intentional misstatement of the financial statements, while fraud is unintentional. Examples of errors are, the management might overlooking the older raw materials, to determine the lower cost or market for inventory, and a mistake in extending prices times quantity on a sales invoice.
Oh. How about fraud?
For fraud, there are two types of fraud. The first one is misappropriation of assets. It can also be called as defalcation or employee fraud. For example, a cashier is taking the money from at the time of sale is made and does not entering the money in the cash register.
So, how about the second one?
Second one is fraudulent financial reporting. It is also known as management fraud. It is an intentional overstatement of sales near the balance sheet date to increase reported earnings.
Wow. That's a lot to take. But I understand it now. So, what do you need me to consult you with?
Okay. Can you tell me what is management assertions under the scope of audit?
All right. Management assertions are part of criteria that the management use to record and disclose the accounting information in the financial statements. These assertions are directly related to approved accounting standards and can be classified into 7 categories.
Oh. I heard about that. The 7 categories are existence, occurrence, rights and obligation, completeness, valuation or allocation, measurement, and presentation and disclosure. But there are some of them that I didn't really understand. Can you explain further about the categories?
Yes. There are 7 categories. The first one is assertions about existence. It is to check whether the assets, obligations and equities included in the balance sheet are also existed in the balance sheet date.
Oh. Okay. The next one is occurrence, right? As I know, occurrence is where the transactions recorded in the financial statement are also occurred during the accounting period. Is that right?
Yes. That's right. Okay. Next, it is the rights and obligation, where the firms have the right towards the assets and obligation towards the liabilities at a given date.
All right. What about completeness, valuation, and measurement?
Well, for completeness, it is where all transactions and accounts should be included and presented in the financial statement. Valuation or allocation is to deal with the assets, liabilities, equities, revenue and expenses accounts that have been included in the financial statements are at the appropriate amounts.
Oh. That's all, right?
No, that is just 6 of the assertions. The last one or the 7th one is presentation and disclosure. It is where the components of the financial statements should be properly combined or separated, described and disclosed.
Wow. So, that is the management assertions, huh? Thank you for your consultation. What's wrong? I'm going to present about transaction-related audit objective for today's audit class. Oh. How can I forget that you are an auditor? Mom, can you explain further about transaction-related audit objective? Oh. That's easy. First you have to know what is it for. It is to help the auditor so that the sufficient competent evidence required by the 3rd standard of fieldwork can be accumulated, and the proper evidence have to be decided to accumulate for classes of transactions, given the circumstances of the engagement. The next one, you have to know there are 6 general transaction-related audit objective. Oh. I know that. There are existence, completeness, accuracy. And I forgot the others. Okay. Tell me about the first 3 that you mention. Existence is about the existence of recorded transactions. This is to know whether recorded transactions have actually occurred. Completeness is to ensure that transactions that should be included in the journals have actually been included. A sale occurred violates the completeness objective when it fails to include a sale in the sales journal and general ledger. Accuracy is to ensure that recorded transactions are stated at the correct amounts, and it is related to accuracy of information for accounting transactions. That's right. Now I will tell you about the next 3. It is the classification of transactions included in the client's journal. For example, it is a cash sales transaction, but we classify it as credit sales. The next one, it is the timing of recording the transactions. This is to ensure that it is on the correct dates. When the transactions are not recorded on the dates the transactions took place, a timing error may be occurred. Oh. I remember about the last one. It is about posting and summarization, right? Yes, you're right. It is related to the accuracy of the transfer of information from recorded transaction in journals to subsidiary record and the general ledger. So, do you understand it now? Yes. I understand it better than before.
Bill, since we are both auditors, may I ask you something about balance-related audit objectives? Sure. What is it? Is it the same as transaction-related audit? No, it is not the same. It is just similar. Usually, it involves transactions that are non-routine and expenses that are unpredictable. There are 9 general balance-related audit objectives. Wow! I forgot that it is that many. Can you tell me about it? Sure. The first one is existence. It is to ensure the amount that should actually be included is the amount included in the financial statements. For example, it is a violation of existence when actually there is no receivable from a customer, but included in the account receivable from that customer in the account receivable trial balance. The second one is completeness. which means the existing amounts are included. It is to ensure the amounts that should be included have actually been included. The third one is accuracy. The amounts included have to be accurate. It refers the included amounts are stated at the correct arithmetic. The number of units of inventory on hand was misstated, the unit price was wrong, or the total was incorrectly extended will make an inventory item on a client's inventory listing wrong. What is next? I fail to remember. Oh, I think I know. Is it proper classification of amount included in the client listing? As I remember, it is to determine whether items on a client's listing are included in the correct accounts. I think the next one is recording transaction in the proper period. The transactions that were recorded near the end of the accounting period are misstated transactions. It is proper to think of cutoff tests as a part of verifying, but auditors perform them as a part of auditing balance sheet accounts. Ha! You're right. And then, there is detail tie-in. The details of the account balance agree with related master file amounts, foot to the total in the account balance, and agree with the total in the general ledger. The details in master files and schedules prepared by client supports the account balances on financial statements. The next one is realizable. The assets are included at the amounts estimated to be realized. It concerns whether the reduction of an account balance from historical cost to net realizable value. It applies only to asset accounts. Oh, I know the next one. It is rights and obligations. Before the asset is acceptable, it must be owned so that it will be included in the financial statements. So, that's all, right? Is it already 9? You forgot one last thing. It is presentation and disclosure. It means the account balances and related disclosure requirements are properly present in the financial statements. The auditor tests to ensure that all balance sheet and income statement accounts and related information are correctly set forth in the financial statement and also properly described in the body and footnotes of the statements. Okay. So that's all 9. Thanks for making me remember. You're welcome.
Hey, Jessica, about today's audit class, I wish you can explain me further. Sure, have a seat. Actually, there are only 2 things under knowledge of clients' business and industry. The first one is industry and external environment. The nature of the client's business and industry affects client business risk and the risk of material misstatements in the financial statements. It helps the auditor to determine the appropriate extent of audit evidence. The importance of understanding the client's business and industry have increased by several factors. There are 3 primary reasons to have a good understanding of the client's industry and external environment. Firstly, the specific industries will associate risks that affect the auditor's assessment of client business risk and acceptable audit risk. Even the auditing companies in the industry is advisable. Next, all clients in certain industries are very common with inherent risk. It aids the auditor in assessing the client's inherent risks. That's just 2. What is the third reason? The third reason is many industries have unique accounting requirement that the auditor must understand to evaluate. It is whether the client's financial statement are in accordance with accounting policies. So, do you remember the other thing under knowledge of client's business and industry? I think I remember. It is business operations and processes. But I don't really understand it. Okay. Let me explain. Knowledge and understanding of the client's business are important because the auditor is to give an opinion on the financial report. Planning the audit of the business unit requires the auditor to take a close look at the business and identify the unit to form a firm. Once the units have been identified, then the auditor-collector can collect the evidence to assess risks, the control environment, the reliance on internal control and client expectation for each subunit. Do you know the next step? Oh, I do remember. The next step is divide the business unit into components, which are manageable parts for planning and executing the actual audit. After the auditor identified the components, the further information need to be gathered in how the audit approach for each component. You're right. Then, After gathered the information, the auditor needs to develop a detailed plan. In this process it consists of two major steps, which is gathering the information and selection of audit procedures. I know this. After obtaining the information, the next step is selection of audit procedures. The selection should concentrate on obtaining sufficient appropriate evidence about the assertions underlying the accounting records of the various components. Good one. That sums up all about knowledge of client's business and industry. Huh. Thanks for the explanation.
Dad, I want to ask you something regarding my audit subject. Sure, son. What is it? What is client business risk? Client business risk is the business risk that the client will face. Business risk is the risk that the auditor gives an unqualified audit opinion when the financial report is materially misstated. There are several factors that cause business risk, which is industry and external environment, business operations and processes, and management and governance. There are three types of audit risk, which is inherent risk, control risk, and detection risk. I'm sure you know that. Yes, I do. Inherent risk is the susceptibility of an assertion to a misstatement that could be material, either individually or when aggregated with other misstatements, assuming that there are no related controls. Control risk is that a misstatement that could occur in an assertion and that could be material, either individually or when aggregated with other misstatements, will not be prevented or detected and to be corrected. But I don't really understand detection risk. Detection risk is the risk that the auditor will not detect a misstatement that exists in an assertion that could be material, either individually or when aggregated with other misstatements. So, that's it? Yup, that's it.
Excuse me, miss. What is analytical procedures? Analytical procedures were originally developed and used for the purposes of financial analysis. However, they are consistently used as an audit tool with a cost-benefit or risk analysis approach to auditing. Unless the auditor has an overall understanding of client's business operations and its environment, it is difficult for him to make informed evaluations of financial data. Oh. How about the importance of analytical procedures? The importance of the analytical procedures, which it is evidence of separate auditing standard, has been issued for the guidance of auditors in conducting this method of evaluating and obtaining evidence. These procedures include a comparison of financial information with the comparable information for prior periods, anticipated results, such as budgets and forecasts, or similar industry information, such as comparison of the entity's ratio of sales to accounts receivables with the industry averages. Oh. I know about the other procedure. It is a study of the interrelationships between the elements of financial information that would be expected to conform to a predictable pattern based on the entity's experience and financial information with relevant non-financial information. But, what is the objectives of the analytical procedures? The objectives of the analytical procedures are to assist the auditor in understanding the client's business, identifying areas of potential risk, and requiring further audit investigation, assessing the extent of other tests to be performed, and also acting as an overall review of the financial statements at the end of the audit. Oh. So that's it, right? One last thing. Analytical procedures can be classified as evaluative or predictive. Evaluating procedures are designed to provide the auditor with an overall understanding of the client's business environment and areas of the potential risk that may require further audit tests. Predictive procedures provide the auditor with an estimate of the level of activity or the balance of an account. Wow. That's a lot to take. But thank you, miss. Hi, Alberto. My daughter asked me about materiality under standard ISA 320. Can you help me to remember?
Hey. Okay. Under standard ISA 320, materiality defined as information as material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statement. Materiality depends on the size of the item or error judged in the particular circumstances of its omission or misstatement.
Okay. There are two types of materiality, right?
That's right. There is quantitative and qualitative. Quantitative is based on amount, while qualitative need more evidence to reduce materiality. Auditors of financial statements should not rely completely on quantitative to determine whether items are material to the financial statements. They must consider both qualitative and quantitative factors in assessing the materiality of differences or omission. Besides, qualitative factors may cause small amounts to become material.
All right. Thanks for helping me remembering.
No problem.